September 2008. A 158-year-old bank collapsed overnight. $600 billion gone. Retirement accounts vanish. Millions lose jobs. But what if I told you the real cause started with a lie so simple it fit it on a billboard? Why rent when you can own? It's 2002. America is still nursing a hangover from the dot-com crash. 9/11's just sucker punched the economy. And Wall Street is twitchy. But don't worry, the Federal Reserve has a plan. Slash interest rates to basically zero. Boom, money's cheap. Borrowing is easy. And suddenly, everyone's favorite national pastime isn't baseball anymore. It's buying a house.
Congratulations! You're approved for $500,000.
But we make $40,000 a year.
Not a problem. Adjustable rate, balloon payment, ninja loan.
Wait, what's a ninja loan?
No income, no job, no assets, no problem.
Back in the early 2000s, home ownership wasn't just a roof and four walls. It was the American dream. And the banks. They started throwing money at people like it was a game show. And everyone was winning. Enter the subprime mortgage. In simple terms, loans for people with bad credit, unstable income, or only the vaguest idea of how money works. As home prices skyrocketed, lenders decided that if you could breathe, you could borrow. Bad credit, no credit, living in a van. Perfect. Here's a luxury condo. Should anyone be worried about paying it back? Not really. If the borrower defaulted, the bank could just resell the house for more. It was a gold rush, a full-blown frenzy. Homes doubled in value in 6 months, and even part-timers with $5 in savings were getting approved for mortgages. Down payments became optional. Lenders printed loans like monopoly money, and brokers collected commissions faster than they could say bubble, all of it fueled by blind faith that housing prices would rise forever, because they always had. But behind the open houses and granite countertops, cracks were beginning to form, literally and metaphorically. What could possibly go wrong? Spoiler, everything. By 2005, buying a house wasn't about stability anymore. It was about flipping it like a pancake and hoping the next beer paid double. Real estate wasn't shelter. It was a lottery ticket.
I teach phonics during the day and buy condos at night. I just bought my third house with zero down. I don't even live in any of them.
Here's your latte. Sorry it took a minute. My bank just called and offered me another penthouse in Miami.
This wasn't investing. It was a national obsession. But beneath the red-hot exterior, rot. Those subprime mortgages everyone was gorging on, they were bad. High risk, low doc, barely verified debt. But Wall Street had a magic trick. They bundled all that junk together, slapped a label on it, and sold it to investors as safe. Introducing mortgage-backed securities, now with 80% more lies. How do you make toxic loans look like gold? Easy. You get the ratings agencies to call them AAA. Here's the part they don't put on the brochure. The ratings agencies were getting paid by the banks they were rating. It's like hiring a food critic, then telling them they won't get paid unless they call your raw chicken Michelin-starred. But Wall Street wasn't done cooking. They took those shaky mortgage bundles and blended them into something even more complicated, collateralized debt obligations, or CDOs. Through financial alchemy, garbage loans became investment-grade assets. Actually, not everyone was fooled. A handful of investors oddballs, skeptics, troublemakers read the fine print. They saw the rot inside the boom. And instead of buying in, they asked a bold question. What if we bet against it?
These loans are garbage. We want to short them. Can you build something that pays us if they go bust? You want to bet against the housing market. That's adorable. Fine. You want insurance. We'll write it. You pay us monthly, and when nothing happens, we pocket the premium.
Wall Street smelled easy money. They cooked up the thing that would eventually blow up the world economy. Credit default swaps, insurance contracts that paid out if those mortgage-backed investments went bad. The weird thing, you didn't have to own the investment to buy the insurance. The whole system was a Jenga tower made of lies and leverage. Every block, a bad mortgage, every layer, a bigger, riskier bet. Who needs ethics when easy money's flowing? At first, it was a whisper. A missed mortgage here, a foreclosure there. But then came the wave. And suddenly, the unthinkable became the headline: home prices are falling. For years, the housing market had been built on wild optimism. But in 2007, someone pulled the wrong block. The subprime loans started to implode. And the mortgage-backed securities, they exploded. Banks that had stuffed their portfolios with AAA-rated bundles suddenly realized they were holding radioactive garbage. Panic spread like wildfire. And then boom. Lehman Brothers, a 158-year-old institution, gone. No bailout. Just a $600 billion crater in the middle of Wall Street. Overnight, banks stopped lending to each other. Credit markets froze solid. It was like someone yanked the power cord on the global economy.
I need a loan to make payroll.
Sorry, no liquidity.
What does that even mean?
It means we're closed. Good luck.
Everything jammed. Retirees watched their pensions evaporate in real time. Millions unemployed. Foreclosures through the roof. This wasn't just Wall Street burning. This was Main Street in freefall. The US government had one impossible choice: let it all burn, or throw billions of taxpayer dollars at the very guys who lit the match. They chose the latter. Enter TARP, the Troubled Asset Relief Program. $700 billion shoveled into burning banks. Why? Because the banks weren't too big to fail. Let them collapse, and they'd take down the global economy. Meanwhile, the Fed, led by Ben Bernanke, was busy rewriting the rules of economics with a money cannon. Interest rates sliced to near zero. And then came quantitative easing, printing money out of thin air to patch the Titanic. And guess what? It kind of worked. Markets calmed down, but the aftermath was brutal. Millions of jobs gone. Families that had never missed a payment suddenly owed more on their homes than the homes were worth. And people were pissed. The people who caused the collapse got bailed out. The people who lived through it got pink slips and food stamps. Wall Street popped champagne. Main Street stood in line for soup. No major Wall Street CEO went to jail. No handcuffs, just golden parachutes and quiet retirements. The system survived, but trust burned to the ground. A generation grew up knowing, when the banks mess up, they get rescued. When you mess up, you get wrecked. Because if 2008 taught us anything, it's that the next crisis doesn't look like the last one. It looks harmless, profitable, inevitable, until it isn't. If you want to understand the forces shaping your financial future, like this video and subscribe to stay ahead of the curve.